What if I told you that the secret to Toyota's global dominance isn't just world-class engineering, it's how they track and allocate their costs internally? That's right. Toyota's famed production system isn't just in-time lean inventory, Kaizen. It's not just about saving time on the assembly line. It's about building a financial system where every internal cost has a home, a purpose, and a return on investment. Because when internal cost allocation is done right, it doesn't just keep auditors happy, it can fuel international expansion, improve transfer pricing compliance, and help a company grow without wasting a cent. So, how does Toyota do it? Stick around because today we are going inside the machine, literally and financially, to uncover the strategic power behind one of the world's leanest enterprises. Welcome to the channel. I'm Michael from Prezzo. I'm a lawyer and economist by training, a business consultant and analyst by profession, and a business owner like probably many of you. I run a company called Prezzo. You can check us out at the link provided in the description below. We actually specialize in transfer pricing, business analysis, and helping small and medium-sized companies to scale by using tested and legal frameworks. We are working with over 100 companies yearly, from tech startups through manufacturers, e-commerce sellers, and I get it. You want clarity, you want real answers, and specific recommendations. And most importantly, you want your business to grow without giving half of your profit away in taxes. That's what this channel is about, and that's what Prezzo is about. So if you are growing a company, trying to scale across borders, structure smarter, or just not get crushed by paperwork, this is the place for you. So today's episode, we are diving into Toyota's internal cost allocation model, how it works, how it supports transfer pricing, and how it can help your business scale globally without losing control of the numbers. Okay, let's get into it. Let's begin with what made Toyota legendary, the Toyota Production System, or TPS. Now, if you studied operations in business school, you've heard of TPS. But if you are in tax, finance, or transfer pricing specifically, I want you to hear it differently. Not just as a manufacturing philosophy, but as a blueprint for financial control. Let's break it down. TPS is often called lean manufacturing, but that's just the surface. The real genius is how Toyota eliminates wastes at every level, including financial waste. No overproduction, no excess inventory, no unnecessary motion, no idle time. Every one of these isn't just an operational inefficiency, it's a cost driver, obviously. So when Toyota stamps out operational waste, what they're really doing is controlling costs at the source. It's finance by design. Just in time, the real foundation of real-time cost visibility. So that's one of the pillars of TPS, is just in time. Producing exactly what's needed when it's needed and in the amount needed. It sounds simple, but from a finance lens, this does something powerful. It generates real cost data. Every unit produced is traceable, time-stamped, and matched with labor, with material and overhead inputs. So when it comes to allocating costs across divisions or entities, Toyota isn't estimating. They are pulling from granular, operationally amped data. Imagine that compared to a traditional manufacturer who reconciles costs as at the month end and with rough approximations, Toyota is doing this on the fly, factory by factory, process by process. Here's where it gets interesting. At Toyota, internal departments are treated like customers. Let's say the R&D team develops a new fuel injection model. They don't just toss the design over the wall to production, they invoice the project, track time, and allocate design costs to the downstream units that use it. That means cost visibility, it's not just top down, it's peer to peer. And this matters for three reasons. Because it incentivizes accountability across departments. It also reduces the costs leakage and cross let's say cross subsidization. And most importantly, it creates audit ready trials for internal allocations. That's wonderful. This internal customer mindset, it's a massive reason Toyota can scale without financial bloat, and it sets the stage for stronger also transfer pricing structures. Now let's talk about Kaizen or continuous improvement. Most companies treat cost optimization as a project. Toyota treats it as a culture. Every team member, from line workers to managers, is empowered to identify waste, suggest process improvements, and tweak workflows. So, how does this relate to internal costing? Simple. Every cost center is constantly getting leaner. Not once a year, not just before budget season, but weekly, daily, sometimes maybe even hourly. This makes cost allocation not only more accurate, but more competitive. And when costs are accurate, transfer prices are justifiable. When they are competitive, they are also defendable. More on that will be in later on in part 3. But because now let's pause for a second. Imagine your company could allocate R&D costs by SKU, by hour, by factory. Imagine if every shared service from IT to logistics could charge out based on live usage data rather than annual budgets or headcount assumptions. That's not sci-fi. That's Toyota. And while most M&As are struggling with SAP, silos, outdated allocation keys, or legacy spreadsheets, beloved ones, Toyota's already building transfer pricing model of operational telemetry. So here's the bottom line of the chapter we just covered. The Toyota production system isn't just an ops model, it's a financial entire architecture. It enables Toyota to understand cost behavior in real time. That's really valuable. They allocate shared costs with, I would say, even surgical precision. That is very allowing to cost management properly. They create audit ready documentation for intercompany pricing too. And all of that, it sets the stage for tax compliance, scalability, and obviously growth. In the next section, we will look at how Toyota actually does internal cost allocation, the mechanism, the math, and how it all flows into transfer pricing. But before we jump there, let us know in the comments. Okay, so most companies treat internal cost allocation like an accounting afterthought, like a quarterly core, a template someone updates just before the budget meeting. But that's not Toyota. For them, internal cost allocation is a strategic infrastructure embedded into how every team, plan, every factory, and service group actually operates. So, what does that look like? So, let's start with the basics. What is internal cost allocation? In simple terms, internal cost allocation is the process of distributing shared costs like HR, IT, logistics, R&D across the departments, maybe some business units or legal entities, obviously. Think of it like splitting the check at the dinner, but instead of friends and wine, it's engineering teams and cloud server usage. So, key types of those internal allocations. There are direct allocation, that means charging a cost directly to the team that caused it. There are indirect allocation because it's spreading the cost across multiple teams using drivers like headcount, revenue, or time. And there is activity-based costing, ABC, allocating based on actual activities. For example, number of support tickets handled of hours of engineering team that they worked. Toyota leans heavily into activity-based costing, the last one, enabled by their hyper detailed operational data. Let's say Toyota's innovation lab designs a new EV battery system. The lab costs $10 million a year to run. In many companies, those costs would get allocated with a blunt instrument, maybe evenly across all product lines or based on revenue. At Toyota, they allocate based on actual design hours consumed per vehicle line tracked through internal systems. That means that the Corolla division only pays for what it used. The Lexus EV team pays probably more because they used more R&D capacity, and every allocation is auditable and explainable. This is precision internal costing, and it creates fair, transparent, and strategic financial statements across business lines. Very useful, right? So let's now focus on intercompany cost allocation. So when it gets a little bit more global. So here's where it gets spicy and relevant to transfer pricing too. Toyota doesn't just allocate costs within Japan, obviously. It allocates across legal entities, geographies, and tax jurisdictions. For example, the centralized IT team in Japan builds a global data management platform. It's used by factories in Thailand and the US, let's say, and the UK. Toyota allocates that cost based on usage, say number of users, data storage, and ticket volume. The cross-border charge has tax implications. It affects like intercompany service fees. It affects, of course, the details of transfer pricing documentation. This is also causing the profit split across different, mentioned before, jurisdictions. And Toyota can defend it because it's grounded in real operational usage, in real business, not guesswork. So why does it this really matters? Because tax authorities increasingly demand proof, and that's really crucial, proof that intercompany charges are based on actual value creation. Trust me, I've been involved in many tax audits. That's really getting more and more focus. They're checking if it's supported by documentation, aligned with the arm's length principle. Toyota's system does all of that. And they do it correctly. They can show what services were delivered, and actually to whom, if they are aligned with arm's length principle. And Toyota system does just that. They can show what services are delivered, to whom, at what volume, and why the price charged reflects the actual usage. That's, I would say, audit gold. It helps them to avoid double taxation, prevent the disputes, and build trust with regulators. Okay, let's now shift gears. Internal allocations aren't just about tax, they are also about strategy. At Toyota, every business unit is treated as a performance center, responsible for its own profit and loss. That includes absorbing its share of central costs too. So when R&D expenses spike or logistics costs climb, local managers feel it immediately. That creates accountability. It also enables more accurate forecasting, which is very valuable for the management. This causes also smarter investment decisions because you're forced to think twice. It's better across for cross-border planning. In short, cost allocation becomes a management tool, valuable management tool, not just for tax or accounting. Do you want to scale globally? First, your allocations first. Here's a question for any multinational executive watching. If you open a new factory, let's say in Mexico, tomorrow, could you accurately allocate central IT, HR, and logistics costs to that entity on day one? If the answer is no, you're not ready to scale. And Toyota is. Their internal systems are so refined that launching a new entity isn't a tax headache. It's just a new node in the network. They know exactly what that entity should pay, what it will receive, and how it fits into the group's value chain. That clarity supports regular actions that every company does: budgeting, pricing, tax compliance, and obviously the long-term growth plans. So to wrap this section all together, at Toyota, internal cost allocation is a living system. It's operational, it's financial, it's strategic, and it connects real-time operational data. So to wrap this section, at Toyota, internal cost allocation is a living system. It's operational, financial, strategic, and it connects. It connects real-time operational data, activity-based costing, cross-border service flows, and there was one more, transfer pricing compliance. In the next part, we'll dive even deeper and explore how this allocation model fuels Toyota's international tax strategy and growth engine. So now we know how Toyota's internal allocation model works precisely, dynamically, and based on real activity. But here's where things get really interesting, because those allocations, they don't just affect internal budgets. They somehow shape international tax outcomes, transfer pricing positions, and even Toyota's global expansion strategy. So let's connect the dots. Here's a provocative thought. Can your internal cost allocation strategy actually reduce your effective tax rate? With Toyota, the answer is yes. Why? Because the more accurately you allocate shared costs, the better positioned you are to set arm's length transfer prices, to avoid profit overstatements in high tax countries, to demonstrate value creation across entire group. So let's unpack that because it's important. Tax authorities around the world care deeply about intercompany charges. When Toyota entity charges another, say for IT services, logistics, or R&D, that pricing must be at arm's length, must be documented, must be justifiable under OECD guidelines or local TP rules because they operate globally. The biggest challenge for most M&As is to prove the value, showing that the service was really delivered and that the cost allocation reflects economic reality. Toyota's operational cost data changes the game. They can show what was built, who used it, how much they used, and why the cost charged is fair. That's a level of precision most companies could only dream of. And it makes Toyota's transfer pricing structures incredibly robust. So let's talk about BEPS, the Base Erosion and Profit Shifting Framework from the OECD. One of the major BEPS concerns is the artificial shifting of profits via inflated intercompany charges. Toyota's response to that: ground every charge in verifiable operational usage. R&D expenses tracked by design hours and model usage. IT costs allocated based on login counts, help, desk requests, and the storage volume. Global logistics coordination split by shipment volume, weight, and warehouse interactions. So the result for it, a transfer pricing framework that isn't theoretical, it's mechanically tied to the business. And when auditors see that kind of linkage, they tend to nod, not challenge. Now, let's talk outcomes. Because this isn't just about looking good in a TP study, it's about real financial benefits. Lower effective tax rates. So, when central costs are allocated accurately, low margin entities don't get overloaded with charges they can't support, which reduces risks of disallowed deductions or forced adjustments. It means also fewer transfer pricing disputes because precision allocations are easier to explain, defend, and justify, reducing the audit friction. It also for better alignment with value creation because Toyota's allocation model mirrors real-world activity, which is the core principle behind modern TP regulation. Here's something strategic. At Toyota, cost allocation isn't just tax compliance, it's business enablement. When a CFO wants to open a new market, say Brazil or Vietnam, they already know what shared services will be used, what they'll cost, how those costs will be allocated, and how to model tax impacts in year one. That's not just about tax, that's about predictability, planning, and profitable scaling. And it's only possible because the allocation model is clear, dynamic, and amped with in real operations. Take Toyota's regional service centers, like its R&D hub in Belgium or IT shared service center in Singapore. These centers serve multiple legal entities. They operate on obviously internal SLAs, track time, they track usage, and they track costs. And obviously, they charge out their services across borders. Toyota uses these hubs not just to centralize expertise, but to strategically manage cost recovery and tax efficiency. For example, a Singapore entity can recover IT costs globally, keeping profit low in a low tax jurisdiction. R&D in Belgium can be structured to align with innovation box incentives under EU tax frameworks. All right, we've seen how Toyota builds precision into every bold and every budget. We've looked at how internal cost allocation can drive operational excellence, support transfer pricing, and fuel tax-smart global growth. But now comes the million-dollar question. What can you actually do with this? Whether you are running a global finance team or advising clients on international tax, how do you take the Toyota mindset and apply it to your own company? Let's turn strategy into action. Let's be real. Not every business has Toyota scale, the discipline, or decades of lean culture. But here's the good news. You don't need 100 factories or a Kaizen army to start thinking strategically about cost allocation. What you do need is a shift in mindset. Instead of treating allocations as accounting cleanup, start thinking of them as drivers of value attribution, foundations for transfer pricing logic, tools for strategic decision making. And that's the real takeaway from Toyota. They build a system where finance is aimed in operations, not separate from it. So, step one, map your shared services. Start with the basics. What services are being shared across departments or entities and how they are being tracked. For example, IT, HR, logistics, procurement, R&D, finance, maybe tax itself. Too often, shared services operate in silos, and their costs get dumped on legal entities at year-end based on budgeted percentage or headcount. That's the fast path to bad allocations and TP exposure, actually. Instead, identify service flows, define internal clients, start logging usage metrics like logins, requests, hours, etc. Create at least simple internal SLAs. Even rough data is better than no data. Here's a common trap. Companies try to use cost drivers that are easy to measure but unfortunately irrelevant. For example, allocating global IT costs based on headcount, even though one entity uses 10x more cloud storage than another. That's, not just kind of lazy, it's dangerous. Toyota avoids this by aligning drivers with economic reality. You can too. Ask yourself, who uses the service? How much do they consume? What drives um, their cost behavior? How frequently does this change? And if you can answer those four questions, you're like already ahead of 80% of the market. Step 2. Build allocation models you can defend. Here's the thing, most tax audits don't break down over pricing, they break down over documentation. So Toyota doesn't just allocate costs, they can explain how, why, and based on what. That's your goal too, because you need to build allocation models because you should like build allocation models that are based on real data, use reasonable explainable drivers, are updated annually at least, come with supporting documentation, charts, logs, time records, etc. It doesn't need to be perfect, it's like just needs to be defensible. You can try with this quick test. Could you explain your internal cost allocation method in 2 slides to actually your CFO, for example, or maybe an external auditor? Could you? Maybe imagine that a skeptical tax inspector enters the room. What do you do? Slide 1, what the service is, how it's delivered, who uses it, and slide 2, how it's allocated, what the cost drivers are, and why it's arm's length. If that sounds impossible, your allocation model needs work. If you can nail that, you are in Toyota territory. Then step 3, link allocation to transfer pricing and then to global strategy. Don't stop at internal efficiency. Your cost allocation model should plug directly into your transfer pricing policies because that's part of your business. Intercompany agreements because that's part of the documentation later on also. Global expansion planning because that's part of the budgeting you do every year probably. And Toyota's approach lets all of them to launch new entities with clear cost-sharing logic, defend cross-border charges with operational evidence, and plan tax outcomes in advance, not after the fact. You can, believe me, adopt the same discipline. Sometimes it requires just the mindset shift. It starts with making sure your tax and finance teams aren't just speaking to each other; they are designing together. And here's like bonus insight. When every business unit is charged for the services it consumes, something amazing happens because people start actually paying attention to cost. Do we really need that many licenses? Why is this project using so much engineering time? Can we renegotiate that shared vendor? Those internal allocations, when done well, drive cost consciousness. They create incentives for efficiency. And that brings your full circle to Toyota's cultural DNA. Operational excellence plus financial precision equals sustainable performance. But here's the truth. If your company is growing across borders, shared service allocation isn't like a nice to have, it's mission critical. You'll need to defend intercompany charges, explain value creation, and explain model tax impacts in multiple jurisdictions. They need to comply with BEPS and local TP regimes. You can't do any of that with a spreadsheet and some guessing. You need a system, a method, a playbook. And Toyota's already written one. So, what's the big lesson? Toyota doesn't treat cost allocation as accounting, they treat it as architecture. It's the blueprint behind their strategy, their growth, and their ability to scale without waste. You don't need to copy Toyota, but you do need to learn from them. So here's your next step. Audit your current cost allocation methods. Talk to your ops teams, see what data you already have. Start small, one function, one region, one model, and build from there. If this episode got you thinking, don't keep it to yourself. And please subscribe for more deep dives on transfer pricing, international tax, and financial strategy. Comment below what's the biggest challenge you faced with cost allocation. Thanks for watching. My name is Michael from Prezzo, and see you in the next one.